Small business tax tips: how to pay yourself from your business. Check out this video to learn the fiscally proper way to pay yourself from your business and to understand why business owner pay is not a salary. Most business owners like to talk about getting a salary from their businesses, but contrary to general belief, that's not how they actually get paid by the companies. They take or draw money from their businesses as owners, depending on their business type. Welcome back, folks, to another edition of the awesome Sweetie Kiwi Show. How you doing today? I hope you are doing fantastic. I'm doing marvelous. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about small business tax tips, how to pay yourself from your business. Now, first, let's talk about how business owners pay themselves. Important though, how you pay yourself out of the business depends on several factors. Depends on your business type, whether you are an LLC, LLP, partnership, S Corp, C Corp, sole proprietorship. It depends on the stage of business you are in now and how much you need for personal expenses. Now let's quickly talk about this. I have on the screen right now, this is the schedule that we have done here. We have put together at the Sweetie Kiwi Show for you. So this schedule shows how different types of business owners get paid and how that pay is shown on their tax returns. Let's just go through them. This is very important. So in one column, I have the owner type, the business type, how to take payments, the tax return classification, and whether there is a self-employment tax. Now let's have a partner. If you are a partner, when you take money out of the company, it's called a distributive share. So you have to show this on your Form 1040, on your individual taxpayers fund Form 1040, and that's on Schedule K1. There is self-employment tax if you withdraw money from the company as a partner or as a partnership. If you are a sole proprietor, when you take money from the company, it's not a distributive share, it's a draw. It's just a withdrawal. A draw is just the accounting terminology here. And you still report that money on Form 1040, but that's on Schedule C. Is there any self-employment tax? Yes. Now let's say you are a single member LLC. Single member LLC is similar to a sole proprietor. The only difference is the legal aspect of things. When you take payments out, it's called a draw. The classification, the tax return classification is the same. So you have a Schedule C, Form 1040, and there is a self-employment tax. If you have a multiple member LLC, you don't have a draw, you have a distributive share. Whenever money is taken out of the company by the owners or the members of the LLC, they are taking a distributive share. And you show this on Form 1040. So each member of the LLC will show on his or her Form 1040 on Schedule K1 that distributive share. Is there self-employment tax? Yes. Let's move now to corporate shareholder. Here we're talking about C Corp, so C Corporation. Now you're getting money, you're getting payments as dividends, right? Because when you sell, by the way, when you sell your stocks and make money and make profits or loss, that's called capital gains or capital losses. The fiscal classification is a different beast. It has nothing to do with dividends here. Here, dividends are considered payments. Dividends are considered income. So you report this on 1040, Form 1040, as dividend income. Is there a self-employment tax? No, there's none on dividends. Let's say you are the shareholder in an S corporation. S corporation, that's also called a subchapter S corporation, and is a little different from C Corp. We have an entire show covering that the distinction between S Corp and C Corp. You might want to double check that. But when payments are taken, those are taken as distributive shares. You put the payments on Form 1040 Schedule K1, and there is no self-employment taxes. The last category here, the last type here is if you are a corporate executive or a staff. Let's say you're the CEO or CFO of a company, you receive a paycheck. You're getting every 2 weeks or every week or every month, you're getting a paycheck. So the tax return classification here is again on Form 1040, but it's on your W-2. All right. So W-2 income, self-employment tax. Yes, you're paying FICA tax as a staff. So as an employee, you're paying FICA tax. I'm talking about Social Security. I'm talking about unemployment insurance and also disability. All right. So this is really the difference here. You can see that for no matter what type of business owner you are or what kind of business type you have to show everything on Form 1040. There are instances where, for example, in the case of a C corp, a C corporation is the only corporation, the only type that pays taxes on its income, and which is not a pass-through entity, and that's done on Form 1120. And if it's a partnership, it'll be Form 1065 partnership. But here in our case, we only have Form 1040. Okay, I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're also having a conversation around how to pay yourself from your business, and we're analyzing this question from a fiscal point of view. Now, if you love the content clarity and quality so far, please consider subscribing to our channel and turn on the notification bell. We'll surely appreciate that. And also like this content if you believe we're adding value to your life. Share and comment below. Now, business owner draw versus distribution. This is a topic that has caused a lot of drama in the last 25 years, not only in academia but also in the industry. So let's talk about business owner draw, when you have a withdrawal, that is, versus distribution. Now, the terms draw and distributive share, we've talked about that in the table above, right? A draw is a direct payment to a sole proprietor from the business. A distributive share is an individual's owner share of income, gain, loss, deduction, or credit. So when you have draw, you're talking that you know automatically that the person taking the draw is the only person owning and ruling that company. So the difference between a draw and a distribution is significant for tax reporting purposes. Why? A sole proprietor or a single member LLC owner can draw money out of the business. This is called a draw, of course. Now, it is purely an accounting transaction, and it will never show up on the owner's tax return. A partner's distribution or a distributive share, on the other hand, must be recorded using, as I said earlier, Schedule K1, and it shows up on the owner's tax return. Now, in the same way as a partner, a member of a multiple owner LLC, and an S corporation shareholder, they take a distributive share with the amount always recorded on Schedule K1. Now, so that's very important. Just kind of recap here. So one thing you have to remember is that sole proprietors take a draw. So if you are a sole proprietor, you're not an employee, and you don't take a salary in the form of a regular paycheck. So there is no FICA taxes, Social Security, Medicare are deducted, and no federal or state income tax is withheld. So, but you have to pay this at the end of the year, so right? So a sole proprietor gets paid, quote unquote, by drawing money from the business. Now, the amounts that are taken from the business by sole proprietors, they may be called a draw because this amount draw down your capital, the ownership account. Now, partners take distribution from profits. That's why we called it distributive share. A partner in a partnership also does not get paid a salary. They take distributions from partnership profits and are taxed based on their share of those profits on their partnership income tax return, right? That's what I said earlier about the Form 1065. Now, how profits are distributed in a partnership or LLC depends on the language of the partnership agreement or LLC operating agreement. LLC owners take a draw or distribution. It really depends. If you have a single member LLC, then that person will take a draw because for tax purposes, they are considered to be analogous, to be similar to sole proprietors. But if you have multiple member LLC, the members are considered to be like partners in a partnership, so they take a distribution. Now, corporate shareholders don't take a draw or a distributive share. They basically receive dividends, right? So an owner of a corporation or S corporation is a shareholder. And as a shareholder, he or she takes dividends when the company's board decides to pay them. But many growing companies don't give dividends, but put the profits of the corporation back into growth. Now, one thing that's very important to analyze when it comes to the fiscal aspect of things is that an S corporation owner who works in the business gets a salary. So corporation and S corporate officers who are involved in the day-to-day running of a business are considered for tax purposes employees, and they must take a salary, and employment taxes must be paid on that salary. Now, besides, as corporation shareholders may take, depending upon the financial situation of the company or the decision of the board, they may take additional distribution of profit from the business. Some S corporations, especially in some sectors, in the tourism sector or in the hospitality or in the oil and gas, they try to pay minimal amounts to corporate officers to avoid employment taxes, right? The thing here is that the IRS has caught up with that, and they said, listen, corporate officers must be paid a reasonable amount. So the IRS therefore has established guidelines for determining what constitutes a reasonable salary based on experience, responsibilities, duties, time spent, comparable amounts paid to others doing similar work, and other factors. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweaty Kiwi. I hope you're doing fantastic. We are in the last section of today's show. We want to talk now about how much to take from your business. How much do you need to draw, or you need to get as a distributive share or as dividends? How much do you need? Now, business owners who take a draw or distribution from profits, they can take any amount they want from the business. Nobody's limiting how much you can take. Of course, you don't want to take money that will be needed to pay employees, pay off business loans, or pay other bills of the business, right? The thing here is it really depends on your operational stage. If you're just starting out, maybe the most important determining factor for your pay is going to be your business cash flow. So things like wages, expenses, and all immediate obligations must be covered with cash. So with limited or no cash flow, a reality for many startups, you might operate for a while without a paycheck, let alone a predictable salary. So as the business grows, as the business is in a growth stage or maturity stage, you may be able to take money from your business on a more regular basis based on your personal financial situation and on the business's financial situation. Now, remember though, that you don't take, as a business owner, you don't take money from profits because they are not in the bank. You take money from the business bank account. So you want to add your personal needs to your business budget and make sure that you have enough each month to meet your business obligations first. Another thing I want to talk about is how self-employment taxes work for business owners. Now, what is self-employment taxes? You have two. You have Social Security and Medicare tax for business owners. So the amount of self-employment tax you must pay is based on the profit of your business, of course. So if the business does not make any profit in any one year, there is no self-employment tax. Now, the amount of self-employment taxes are not withheld from any payments to business owners. Right? Now, of course, these taxes, they are still due and payable around April 15th, right? Around tax time. So sole proprietors, partners, and LLC members, they must pay self-employment tax when they complete their personal tax returns for the year. So that is the 1040. As corporation owners, are not considered self-employed. Remember that we talked about that. So the self-employment tax, therefore, is computed and added to the income tax due. So self-employment taxes are paid to the IRS along with federal income taxes. Another thing that you want to remember, and this will be my last statement here, no taxes are ever withheld from your income as a business owner. But to avoid underpayment penalties, you may need to make quarterly estimated tax payment to the IRS, considering both federal income tax and self-employment tax you owe. Okay, so this is it, folks. Here's today's recap. Small business tax tips: how to pay yourself from your business. First, you want to understand how business owners pay themselves. I explained to you business owner draw versus distribution, that distinction that is critical, especially from a tax perspective, how much to take from your business, and how self-employment taxes work for business owners. I will see you next time, but until then, remember, stay marvelous.